The last time you had a balanced budget in the States was in the year 2000 under Clinton. As far as I understand it, a large part of it was a very strong stock market with a lot of tax receipts on the back of it. And you've had a very strong stock market again, but also a record deficit. There's quite a lot of value to be found. And I'm not suggesting there's going to be a great trade the next 10 years because most stones have been unturned recently. But there is definitely a valuation gap between the US and the rest of the world.
Charlie Morris is a fan favorite here at BPAE. He runs ByteTree Research, and he's the closest thing to one of those friends you can talk about anything with in the investing space. Stocks, bonds, commodities, treasuries, whatever it is you want, he can speak about that. And today, he's going to talk about one of his top investments, which is simple and complicated at the same time. It's TLT, which is the iShares long-term Treasury Bond ETF, long-term meaning 20 years plus. So basically, a long-term risk-free asset. I won't steal more of Charlie's thunder. I'll let him explain why he thinks TLT is an interesting investment right now. Charlie, first, welcome.
James, a pleasure to be here. Always a pleasure.
Charlie, it's always great to have you. And your videos get a lot of comments, a lot of engagement. So I'm delighted to have you back. Your pick, as I mentioned, TLT is, in some ways, it looks deceptively simple. It's just a bet on long-term risk-free assets, but there's also a lot of complexity that goes into that simplicity. So can you walk our audience through what you're seeing when you see TLT?
Certainly. I think the long bond, and by the way, what I've actually done with my clients here in the UK is recommend British bonds rather than American ones. We don't have the currency risk, but for your audience, I would say the American bonds. And by the way, they're very close together. They trade quite tight most of the time over the last 3 decades. And the long bond in America has been a most shockingly bad investment these last 5 years, as it has been in most of the world. And that's because interest rates were, at zero, and they went up to 5% plus, and that is catastrophic for the long end of the bond market. So the reason you'd buy it is because we think that that's enough, that's done. We believe that, we're at the point where we're no longer going to see high yields and possibly we're going to see lower yields. Now, we've already had the rate cuts, they've begun in Europe and in the US. They might not happen quickly from here, but I don't think that really matters. The fact is they're going to happen. And inflation does seem, although not low, it's no longer spiraling out of control in terms of the change. We're never going to get the low prices back, but it's not going to spiral in the near future. We've got oil at 72, these sorts of things. It's just wages that are going to stay high, but many other things will probably.
Yeah, service inflation is really the biggest driver of that. Yeah,
sure. So I think we're at a point now where the yield was testing 5% the other day. And it rejected it. We had that test in 2022. We had another big test last year, and we've had the latest test. And he's thrown everything at it. You had the UK budget 2 years ago, which blew up the British gilts market, which caused a global event. Then we had the inflation, resurfacing fears last year that didn't come through. And then recently we've had the Trump election, which last time was a big yield shock. Because don't forget, yields going up doesn't just mean that we can't pay our bills in the future. It also could mean a high growth environment, right? So Trump is deemed to be a growth president for the United economy, and even on the Trump trade, we didn't see Treasury yields blow. So I think that it's a reasonable assumption now to say we've thrown everything we possibly can at this, and I think that the long bond is really a pretty reasonable place to be from now.
Interesting. Let me ask you, I think, a kind of a standard question about this. I had it on the screen a minute ago, the chart. Let me bring it right back up for a moment here. So, as we know, bond prices and yields move inversely, and interest rates affect bonds. When new bonds coming out pay higher rates, nobody's going to want those old bonds that pay lower rates unless the price drops, right? So, we had rates rise for quite a while, and you can see the price here. It's almost cut in half from its high. Not quite, but it went down quite a bit as rates rose. Recently in the US, rates have started to come down again. I believe it was the day Trump got elected, though, the bond market reacted. Trump himself is ostensibly strongly anti-inflation, and he's ostensibly for a weak dollar. However, the market doesn't believe him. The market believes that he's going to spend a lot of money, that his policies of deportation, of tariffs, of reduced taxes, which just keeps more money floating around in the economy, these things seem inflationary. And you mentioned Trump is a very pro-growth kind of guy. And so if I am a bond investor and I fear inflation, I'm going to step out of bonds. Do you think that, A, how material is that risk? And B, is it overblown? I mean, what is the market missing here?
Well, there's a few things it's missing. I mean, firstly, we've got deflation being exported from China. That's quite important. Europe's hardly in great shape, and so there's soft prices there. The decline of the German industrial complex is really it's really not very funny. It's quite a problem. And so you bring all that deflationary forces around the world have reasserted themselves. And the only reason you're going to get lots of inflation if they go and print lots of money in the United States. It just doesn't seem very likely. You've just appointed the Doge Committee, and Musk and Raswani, isn't it? Is that his name?
Vishwami, yeah. Vivek, yep.
Yeah, Vivek. Yeah, you've got those guys who are saying they're going to rip $2 trillion out of the budget deficit, which I think that's probably a bit ambitious. But it's a 6% deficit.
Ambitious, yep.
It's a 6% deficit, and Scott Besler, who's come in, who I think is a financial A-lister. I mean, he's a very credible guy, and they're talking.
A billionaire too. Yeah,
sure. So he's talking about halving the budget from 6 to 3. But it doesn't really matter whether you get rid of all the budget deficit or whether you halve the budget deficit. That is the kind of talk the bond market loves to hear. Yeah. So if you're thinking, oh my God, the world's going to shit because we're borrowing too much money and we're going to hand it out to our children, we'll never be able to repay US Treasuries, British gilts, German bonds. There's just too many of them. The truth is, if you just balance the budget, the debt GDP ratio takes care of itself. All you need to do is balance the budget for year after year after year, and soon you don't have any debt. So it's funny that no one really wants to do that, but they have been doing it in some countries, like Northern Europe. They have been quite disciplined. Admittedly, they have a lot of debt on the private sector, but the politics of the today is such that people have just wanted freebies from the government, and I think that this could be the end of that. And thank God, because we do need to turn the political tide globally. This whole sort of soft politics where the government's there is an open kind of checkbook. It's just not how the world is supposed to work. What you do is you grow the state and then you crowd out the private sector. But if you rein back the state, which happens naturally by balancing the budget, which is what, by the way, your mum probably taught you in how to manage your household affairs, then it just works. I mean, it's not rocket science. And so now the greatest countries in the world, particularly, Argentina kicked off this fashionable trend of balancing the budget with Malay. Now we've got America doing it. And I just hope it comes over here. Because if you guys do it and make it work, then we'll follow.
I was in Argentina a few months ago, Charlie. It's just amazing how far the U.S. dollar, and I'm sure the British pound goes. But Milei is really making amazing progress. If you've seen some of the charts of inflation, has come way, way down. Certainly, that's an example of hard politics as opposed to the soft politics you mentioned. And the hard politics are working. In theory, everything you say makes sense. In fact, I was at a conference in New York City a few weeks ago, and the U.S. debt level was something that was of concern on both sides of the aisle. I think there were Republicans and Democrats equally concerned. It's a bipartisan issue right now. And the deficit obviously contributes to that, I should say, year by year. But and I guess one more point is the U.S. has had high debt in the past and has outgrown that debt over time with a balanced budget, meaning it's not quite this. It's similar to a household finance situation, but when you print your own money, it's a little bit different when you have your debt, as long as the U.S. retains its sort of national credibility. I guess my question is, though, like what probability would you assign to, and I know this is speculating because it's politics, to the US even come close to balancing the budget? It seems like it's such a long shot.
I think you've got this A team in place to do the job. They've said they're going to do it. I can't believe it's difficult to find savings in government if you try hard. You've got the mandate, and you're backed by the president, and you've got the clean sweep as Trump has. So I think that if not now, when? So it would be pretty frightening. And
yeah, fair point. Yeah.
The last time you had a balanced budget in the States was in the year 2000 under Clinton, and as far as I understand it, a large part of it was a very strong stock market with a lot of tax receipts on the back of it. And you've had a very strong stock market again, but also a record deficit. So there's something seriously wrong. If we had a stock market that was in trouble, if the US stock market came down, you stopped getting the tax receipts, presuming the deficit would be under huge pressure. So this is really quite an emergency, and I just think the very fact that we're actually talking about it, not you and I, because this is a conversation we would have probably had 5 or 10 years ago, but the fact that the politicians are putting it as a lead issue is thank God for that.
Got it. So you're basically betting the market is a bit pessimistic on what's going to happen, and so if somebody buys TLT, they're exploiting that blind spot in the market. I tend to think of investments as exploiting the cognitive weaknesses of other people, which sounds predatory, but they're trying to do the same to you. You think the market is sort of underweighting that. Let me ask you then a related question, Charlie. And it's oblique, but you'll see what I'm getting at. What do you think of emerging markets right now? If you look at the history of emerging markets, they basically traded inverse to the US dollar's strength. We had a weak dollar in the early 2000s, and emerging markets went on a tear. But after 2008, 2009, the financial crisis, we had a strong dollar very consistently, and emerging markets have basically delivered next to nothing per year. What do you think of them now?
So emerging markets is a term that used to make a lot more sense than it does today, because you've got a few nasties in there. So I think that we've just got to strip out the countries which we don't really want to discuss. So obviously there's Russia, which is no bid, but there's also China, which is a geopolitical macro complex situation that's different from the rest of them. So when I talk about emerging markets, I think I mean Mexico and Brazil and Argentina and Turkey and India and Indonesia and Thailand, these sorts of places, right? And maybe some of the stars, investable countries, which are basically not considered to be developed. And,
but yet which have dollar denominated debt generally. Yeah.
Some do, some don't. But the good ones don't have very much, because they've all learned the hard way that that's a very, very quick way to poverty, is to run up debts in a foreign currency. So, most emerging markets, I think one of the big things over the last 2 decades is they've all built their own bond markets. So the local currency bond markets in these places are much stronger than they were back in the day. They're pretty much non-existent. And the great thing about debt in your own currency is you never default, because you can always print it. Yeah. And so why you might technically, even true for America or my country, any country, you could print your own debt if you issue it in that currency. Someone else's currency, you've got a problem. And so what gives? And it would be the value of the currency. So if the dollar, if there was too much debt in America and they couldn't pay it back, obviously you'd print lots of money, so you'd get inflation, and the dollar would come down. And that's what we see. That's what's happened in many emerging markets. Emerging markets are now just really offer really great value. So you do need to be more selective these days. And I do think that countries like Brazil and Mexico, which have just been really weak in the run up to the election, they just offer such incredible value. And on a 10-year view, what people say, like Trump's sanctions and things, it just doesn't matter in the big scheme of things. What matters is the value on a 10-year basis. On a 6-month basis, okay, we can worry about the chat and the rumors and the problems, but on a 10-year basis, it really is the value. Huge amounts of value in Latin America and in Asia. So very bullish on that on a long-term view. Yes, we could all pick them apart one by one on a short-term view.
But it's a fair point. A long time ago, I remember financial advisors here in the U.S. used to put assets into U.S. and international. And then this is like, 30, 40 years ago. And then they realized, well, international is too broad of a term. Then we'll have developed markets and emerging markets. And I think you're right. Emerging markets is still too broad of a term. It's just a more nuanced world, and that's a good thing. But let me ask you one more international question, Charlie. You are in the UK now, and I've had the privilege of working in the financial industry in the UK for a couple of periods of my life. What do you think of UK investments? I know from the US there's a perception that Europe writ large is having just a huge productivity crisis. You send somebody in the UK an email at 5:01 p.m. and you're not hearing back until the next day if you're lucky. But then again, prices are reasonable. How does that balance out in your mind?
Well, I mean, there are different ways of looking at it. I think inherently Europe is a very, very vibrant and rich place. We're trying our hardest to destroy it politically at the moment. And one of the problems would be overregulation. Another problem would be overtaxation. And I think the most important one would be the elevated price of energy. The pursuit of green policies is very dangerous for the economy here. And the people don't seem to get it, but the politicians seem to absolutely insist on it. I mean, no one's ever voted for any of it, but every single person you vote for ends up doubling down on even more green stuff. I mean, for example, Boris Johnson in 2019, in his manifesto, it was a sixth point, not the number 1 point, 2 point, 3, sixth, something about net zero by 2050. And as soon as he does it, the Liberal Democrats, that's the middle party, not left or right, the middle guys, they went, oh, we'll do 2045. And then the Labour Party, that's the left one, they go, oh, we'll do 2035. And then somehow it ends up being 2030. So what started off as a sort of 2019 to 2050, wow, that's quite a long time, 31 years, to gently steer the country towards some kind of new energy system. Fine, 31 years. And it's just been accelerated for political reasons, without the science. And we just closed a factory in the UK, car manufacturing plant. Stellantis did it, it made vans actually, on the back of net zero. It's just, there are all these rules where you've got to sell a certain number of EVs before you can sell a petrol car. And there's a ratio and it gets squeezed. And then there's huge amounts of wind being built in the North Sea. So much wind that we can't even use it. And so on a windy day, we've already got 60% of electricity covered by wind on a windy day. Yeah, but apparently we're going to have 10 times this. What the hell do you do with it? And you can't export it because the people on the other side of the channel have got wind as well.
Yeah, fair point. As a outdoor type person, I'm a big environmentalist, but there's also I'm a big capitalist too, and there's this reality that it's a global game theory, and if you stop something in your place, you export the nasties to somewhere else, generally speaking, unless you can get a truly global solution. The US saw that happen with semiconductor chips, with metals, like the rare earths. We didn't want to tear up the environment here, but China was happy to, and now they got a total domination on that. And I don't think the world as a globe literally is any better off because we just exported that mining to somebody else. And a lot of that has been true with energy. We saw with Russia's invasion of Ukraine, how interconnected things really are. It's a water balloon. You squeeze one side, the other side pops up. I think that principle is underappreciated by probably most people.
Yeah, that's absolutely right. But it is a strange one. And I think common sense always comes around in the end. And we will get there. But at the moment, in the UK, it's now become public that we've got the highest electricity prices in the world. And it needs to go back 15 years when the price of natural gas here in America was the same. Yeah, or approximately the same. And it's all a green policy. And we've got the North Sea full of oil and gas, and there's no new licenses for exploration. We have shale, but we're not allowed to exploit it. It's a very different policy to what you guys are seeing. Drill, baby, drill.
But on a net basis, where would you put your money between U.S. stocks and UK stocks?
So there are a lot of companies that don't actually have large energy bills. So if you're heavy industry, then energy is a really big deal. But if you're a company that's doing intellectual property, research or lawyer or accountant or that's services, then actually the cost of energy is not a big deal, because your margins are very high and that sort of thing.
Yeah.
So I think the tech industry, the support services, all those things are absolutely fine, and there are lots and lots of great companies both here and in Europe doing lots and lots of niches. But what we don't have are big tech giants. The Americans bought all of them.
We do big very well. Charlie, as we start to wrap up here, anything else you think investors are missing these days? We talked about Europe, US, a little bit about emerging markets. We talked about TLT being one of your preferred investments right now because you think people are underestimating what's going to happen with the US economy. Any other blind spots? Anything else on your radar of interest?
Yeah, so the TLT, just to double down on that, I'm saying on the one hand, I think that the conversation changing for, unlimited debt stops. And so that actually puts focus on the bond market, and big money could come now because people go, okay, they're taking it seriously. They're actually worrying about it. There's also, it provides protection. So if we find that the bond market's credible again and inflation's down, then if there is a problem in the stock market, which is going to come sooner or later, then the bonds hopefully will go up during that time. So it could be a pretty effective hedge. So I think that's going to be important. But as I say, if you own good countries around the world for non-US investment, good countries around the world that are politically stable and all the rest of it, I think generally speaking, there's quite a lot of value to be found. I'm not suggesting there's going to be a great trade the next 10 years because most stones have been unturned recently. But there is definitely a valuation gap between the US and the rest of the world. And if I was an American investor with up to here in S&P, which is 30% in a couple of stocks, then I would be very happy to seek a bit more diversification.
Probably a bit top heavy here. Yes, absolutely right. And if people want to uncover some of those values, I'm guessing you might send them to ByteTree Research, where you provide different forms of analysis for investors who subscribe to your services. ByteTree.com is the website for that?
ByteTree.com, BYT tree. That's a money tree because we've got a bit of a crypto background as well. Digital money tree is what a ByteTree would be. But we're also on Substack. And you can, for free, we put out a monthly gold report and we do a piece on our Bitcoin and gold index and some other things like that. So there's quite a lot of free stuff on our site, which is worth looking.
Great. We'll put some links up on the screen or in the show notes. And Atlas Pulse, was it at Twitter? I'm not a Twitter guy, but I think it's something
else. Twitter, my ex is at Atlas Pulse, at Atlas as in map and Pulse as in like that.
Okay, interesting. Charlie Morris, always a pleasure to talk to you. I feel like I learn something every single time. I learn several things every single time, I should say, and I believe a lot of the audience does as well. Thank you so much for taking the time to share your ideas with us, and thanks to you guys, as always, for watching us at home.